Welcome back to the channel, guys. I just want to talk about retiring with cover calls. And can you realistically retire completely on cover calls, or do you need a bit more of a kind of standard approach and mixed portfolio? I kind of want to unpack the potential, the pitfalls, talk about the income side of things and how it can form and fit into part of a normal portfolio. So what do we typically expect from an annualized return from a kind of income generating cover call fund? 8 to 24%, what I think is practical. And we'll talk a little bit around NAV erosion and why I've picked the 8 to 24% kind of number. Obviously, the primary trade-off is really the capped upside and the mixed growth. And we've done a few videos now talking about that and the potential of the slippage that you accept when you go into cover calls. So let's just remind ourselves in terms of what a cover call is. You're basically, writing a contract on 100 shares of a stock. For that contract, you have a set price that you are selling or willing to sell your shares at. And then someone's going to pay you a premium for the luxury of writing that option. So if we sold a call option for $2 per share, each option contract represents those 100 shares, you'd receive $200 in income. So you obviously get that immediate premium income. What people sometimes don't realize is that as soon as you open the contract, you get that premium straight away. So that $200 comes into your account straight away. So it's almost like a bit of an upfront payment. It's not like you're waiting for that expiry date to then get $200. Obviously, it limits some of the downsides. So obviously, if the price goes down, you get that premium to offset, and it doesn't always fully offset the downside, but it gives you some protection. And when we saw QYLD and JP's example against the NASDAQ, we actually saw that when the NASDAQ and the corresponding fund index went down, the actual ETF actually outperformed. Obviously, you've got to sell your shares if it hits that strike price. And then there are some other implications around that, which we'll talk about a little bit later on. Okay, so just to kind of give you an idea of the performance versus a standard fund in different various markets. So what will happen in a kind of strong bull market, sort of flat sideways market, and a bear market. A flat sideways market is where, compared to a simple buy and hold, these will outperform typically. And the outperformance can be quite a bit. And here's kind of a representation, and we can see, 50% if we were to buy and hold, and 35%. So you capture 20% more in a sideways market. We always kind of recognize that cover calls are always on a slightly bullish strategy. And the reason for that is ultimately you're expecting the price to go up. So therefore you're eking out that premium. But obviously you don't want it to kind of whipsaw up and go through your typical strike price. So that's ultimately what you're trying to avoid with these funds. If we look in a strong sort of bull market, you'll see a massive underperformance. So here we're at 40%, and that's obviously the market return. So it's 100%. So you're giving up 60%. And we saw this in the other video I showed you, 3x your loss in terms of that gap, in a really strong bull market. So obviously, markets on a big rally, this is why we see that lag indicator almost happening. In a sort of bear market, as I've kind of alluded to, you still go down, take the full downside, but the premium that you're generating in that earlier example, that $200 is kind of offsetting that. We can see that with a 60% drop, you're dropping 45%. So you can see how in two market conditions, you can outperform. In one market condition, you will underperform. And everyone says, well, it's great. Surely, 2 out of 3 is not bad. The challenge is most of the time markets are going up and rallying. And so the reality is this market condition is the most common market condition out of the other 3, and it's the most consistent one over time. Okay, so what are the kind of unavoidable risks and limitations when it comes to retirees in particular? Obviously, the biggest one, which we've talked about at the start, is the capping the upside potential. So you're forfeiting all the gains beyond the strike price. If your stocks surge, you miss out on that appreciation, and the opportunity cost of the rising market is obviously there. You've still got the limited downside protection, but what we've got to realize is that you're still exposed to that loss. And, if we get an over decline, the premium isn't going to offset that decline. Let's say we drop by 10%, we get paid 2%, it's not going to offset that completely. The other issue is that the assignment risk and the taxes. So obviously, the good thing with a covered call is, provided you've got a strike price above your average price, you can't lose. That's one good thing with a covered call strategy, because you've got the premium, which is guaranteed when you write the contract, and you've got the money up to the strike price, and you normally set the strike price above your average. So all you're doing is you're saying, well, if my average price is 150, I'm going to go 10% above that. So as long as it stays within that range, or even if it goes above that range, at least I know I'm going to be in profit. I'm just forced to sell my shares. The downside that is, obviously it could lead to capital gains then, because as I go above my strike, if I'm setting it out the money above my average, if this is in a non-taxable account, then you've got the challenge of not only assignment risk, but also the taxes that are associated to it. Now, obviously, the other side to this is, if you're doing this yourself, there's obviously the management side of actually writing the options, rolling them, buying them back, understanding options mechanics, understanding the Greeks. We will talk about all of these things in the future, but it's important to understand that sometimes it's easier to buy some of these ETFs and pay that management fee because of the fact that, there is that challenge of understanding these things. The other advantage, obviously, for some is going back to the earlier point around taxes and the active management side. Obviously, having these in tax wrappers, certainly in the UK, in an ISA or a SIP, can obviously be beneficial in terms of any risk that you have in terms of the capital gains and having to worry about the active management side. Okay, yield. I want to talk about yield a lot, because I think a lot of people get caught out by this, particularly younger investors or new investors. They fall down what commonly termed as a yield trap, or chasing the yield. And what we'll see is there's kind of this sweet spot where, as you kind of go further out in terms of the strike prices, you're obviously able to capture more of that upside, but you get less yield. And the inverse is kind of true. So, if you go quite close to the current price with the strike price, you get the higher premiums, but you risk that call away. So what we need to understand here is that just because you see a very high yield doesn't mean that that's going to equate to decent total returns. You could be better off having a lower, accepting a lower kind of strike price, but then getting a better annualized total return. So there's always this trade-off again, between the two. The more aggressive you are, the more you can essentially lose from a total returns perspective. I just wanted to cover a quick example here of a working example of a cover call here in different market conditions as well. If the stock declines and is flat, so let's say initial price is 100, strike price is 105, premium received is 2, but expiry is 90. Our end position is 9,200. So in this scenario, we're actually down 800, but we haven't lost our shares because we are below our strike price at expiration, and we've made the 200 from the premium. So actually, some of that other loss that we would have seen, 9,000, we've actually offset that a little bit by having the 200. And this is why in a sort of flat market or a slightly declining market, we can offset some of that decline or actually be profitable. So that's the important point, with these. If we are very much the strike price, so let's say we are initial stock price, again, 100, strike price 105, premium received is still 2, but the strike price expiry ends up at 105. This is where we're doing quite well, because we've now, over our starting position, 10,700. So we've actually made 700% profit. The reason is that although we've gone over our kind of strike price, we have actually captured a lot of the premium and the increase in the actual price overall. And then if it goes above our strike price quite a bit, so this is where you've got 100, 105 is the strike price, premium 2 again, stock price expiry is 115 now. So we've gone 10 above, we can actually see that we're capped out now. So we don't get any more than the 700 that we had before. So you can see that we got the 105, which is what we had before, which is our cap. We still made the same amount of premium, and therefore we still made the overall amount of profit. So this is what I meant by you're capped out, but you're never going to make a loss in this particular example with covered calls. So that's why it's called covered call, because you're covered by the shares you have. Okay. So it's important to kind of understand this concept of even a decline market, you can still go down overall from a position perspective because the premium is not offsetting that drop that we talked about. In a flat market, you're probably going to outperform the market. In a situation where it's kind of matching, you're capped out. If it goes above, you're still capped out and you've lost that opportunity loss. Now, obviously, if you want to kind of rebuy back and do the strategy again, the challenge then is you've got to buy back at a higher price to maintain that strategy. And therefore the amount of shares you own and therefore the amount of contracts and the premium you're going to generate might be less in the future if it goes above your strike price, where if it's the same as your strike price or below, you can continue to write the same amount of contracts and potentially, depending on what the volatility is like, earn the same amount before. Now, we'll talk about in future videos around how you can run what's called the will strategy, where if your shares were called away, you could then write a put, and then you could arguably then get your shares back at a price that you're willing to pay for them again, and then run call again. So we'll talk about all these kind of strategies a little bit later on, but I just want to give you kind of a visual view of how these kind of work. So in terms of going back to the conundrum around, can we live off these? So imagine I wanted to get a target income of 5K a month, so 60K annually. What I want to kind of show is that the yield does matter from a calculation perspective to give you an idea of how much you can earn. So obviously, if we've got a capital yield of 5%, it's going to take us 1.2 million. But what's interesting, if we double that yield, that halves with the amount of capital we need. And this is why people tend to fall down the yield trap a little bit, because they seem to say, well, if I've got a higher yield, but you need to look at that from a average perspective or a medium perspective, which is what I do on the dashboard. So you can kind of take out those highs and lows and actually look at it. So for example, a fund like QYLD has historically always paid around about 12% consistently. So at least you've got a number there that's easy to work off, to work out, okay, this is how much I need to generate that 5K a month. We'll talk about the sort of the higher yield funds in a second. But what you've got to be kind of careful of is obviously making sure that you're looking at total returns overall. Okay, so let's look at the current kind of modern approach to cover calls. So we've got the traditional ones like the QYLDs, the Jet Qs, etc. But then we've got these new, more aggressive single stock style cover calls from like YieldMax, Income Shares, Roundhill, etc. So what's the appeal to these? Obviously, I talked earlier around how managing these things can be complex if you don't understand them. So there's obviously the simplicity side. No direct option trading knowledge. You don't need to understand options. Some ETFs are spread across multiple underlying stocks. There is like YMAP, for example, that's come out, or the European YMAG from YieldMax /Han ETF, which has got some of that diversity. You've then obviously got passive income, so those regular distributions, and at the moment they're monthly. In the US they've started to go weekly as well, and there's rumors of some even daily ones, which is crazy. But what's the risk? Obviously, that main risk still remains the capped upside. Like the individual cover calls, these funds sacrifice significant growth potential, and that remains. Obviously, there is downside protection, but a lot of people think that it's going to offset all the downside. It isn't. It's a percentage of that. So you're still exposed to the major market kind of downside. So you are getting the full downside, but you are getting some inherent protection there. Obviously, if you're buying single stock, a lot of people forget about, yes, there's a lot of implied volatility there from the single stock, obviously, but there is that single stock risk. Anything that happens with that single stock, for example, if Tesla decides to drop by 40%, you're going to drop by 40%. If Tesla then decides to whipsaw back up the next day, you're not going to be capturing that. You're capped, as we saw earlier in that earlier example. So yes, you're getting the extra premium from that extra volatility, but you potentially taking in additional concentration risk in a single stock or a single sector, with these. Obviously, the final thing is fees. Often fees get kind of hidden behind and people don't often look at fees, but if you were to compound fees over time, it does erode your total returns. And I do want to kind of do an example of this, so, in another video around how much of an impact fees can make over time as your portfolio grows. I think people will probably get quite shocked by that, but I think it's important for people to understand this. Okay, I just want to talk about high yield, return of capital. I know this comes up a lot as well. Now, we need to be careful around like return of capital. Sometimes return of capital in a lot of instances, certainly in the case of YieldMax, is normally just how they're managing the fund, and it's a tax thing less than an actual return of capital. So, Jay does talk about this a lot in some videos on YouTube where return of capital is not what people think it is. It's not a case of actually getting your money back. It's not a case of, you put in a bit of money and they give you the premium plus a little bit extra. It's just how, on the trades, when they lose money on the trades and offset that, it's how they treat it within the fund for a return of capital, which actually helps from a tax perspective, from an end investor perspective. So I just want to be careful around the return of capital in the true sense of return of capital, and then return of capital in terms of tax treatment. They are very different. And I just want to give an example of general return of capital and erosion in the NAV. But I just want to mention that there's a lot of confusion. And if people want to put it in the comments, maybe I'll do a separate video on explaining the differences. But I think there is still a lot of confusion here. So let's talk about true NAV erosion or return of capital, where let's say my initial NAV was 1,000, the high yield was 50%, the total distribution was 500, but they only generated 100 from the options premium, and then they paid out 400. The end result would be a 600 drop in the resulting NAV. So they've overpaid from what they've generated. So, there'll be 400 return of capital. But again, I want to caveat that it isn't happening in income shares because I've been tracking it. And, we've heard from Jay that this doesn't happen often in YieldMax as well. So this is why it's always really important to follow the data and understand the data and not read into people writing the hype around, oh yeah, it's return of capital, you get your money back, etc. It's really important that you understand these funds and you spend time doing your homework and research into these funds. Okay, I kind of want to talk about sustainability of yields, income and the capital preservation. So for covered call strategies, for capital appreciation, they're just true income generators. They're not return of capital. The kind of expected yields are significantly lower than the kind of ultra high yield ones. But there are different strategies that people can do, right? They can write out the money and they can write different strike prices, and therefore they can capture different upside. There are so many nuances and strategies within covered calls. It's amazing. At some point, maybe I'll do again another video on covering all these different strategies, but it's worth realizing that, the NAV can go down because the strategy is too aggressive, but there are ways of almost mitigating that through different strategy approaches. What I also want to talk about is covered calls could be kind of single stock risk, or they could be done on, lower volatility or groups of stocks, whether that be indexes or whether that be particular groups of, let's say, big tech, as an example with YieldMax. Again, the different diversifications give you a bit more balance. And if there is any whipsawing in one individual stock, it's offset by the stability of another one, let's say. We've got to remember the prioritization of covered calls is the total return in terms of the price appreciation, the yield. So again, the yield because it's short time. So much yes, paying 50% yield, but NAV is 50% rather than getting it 3% distribution. So again, the focus would be what are my total returns over time. That's why I kind of mention that I guess you have and get stable distribution something between the 8 to 24% range. I think it's safely view that 2.2%, but you could argue with a single stock increase that to slightly higher, maximum 3-4%. But I think after that, you are going to see that NAV, that true drop in the NAV because the amount they're giving out is just so high. But again, we need to be careful around definition of NAV erosion. There's a lot of confusion around that as well, and stock splits, etc. I've done it on the main video. On the main channel. I've done a video on stock splits, which I recommend people go and watch, but you just need to be careful of understanding all of these things. Okay. I kind of want to talk about, just looking beyond covered calls, looking at kind of the overall income strategies and alternatives. So we talked about covered calls being the main one around the fact that you can make income, but that income could be vast between the months. If it's a monthly pay, it could be, $1, then go down to $0.50, then go up to $2. Variability, very improvement, which is really hard to live off, because if you're trying to plan for retirement and you want to have a target income in mind, and these payments are all over the place, unless you're good at budgeting, or if you're willing to accept, although my annual income is going to be 60K, but one month I might get 5K, another month I might get 1K, etc. And it could be that wild, right? Depending on which single stocks you're in, etc. And if you don't have a balanced cover call portfolio, you're going to have to deal with that. Now, obviously, if you took a slightly balanced one that's been around for a while, let's say a QYLD or a JetQ, where you kind of know it's in that 9 to 12, then it's obviously a little bit easier to kind of balance off it, but then you need a higher fund value, as we saw with, how much income it takes to generate. Obviously, the growth potential is very much capped on the upside, but that's the trade-off of what you take. But the risk level is higher because you're obviously taking that single equity risk, and you're also having to deal with the fact that it could actually get called away, etc. If you are getting this done for a fund manager, it's fairly simple and forget. You buy the fund and you pay the fees. Obviously, it would be a lot more active management if you were doing it, yourself. Okay. Dividend investing is typically more stable in terms of the income. It's a bit more predictable. Or, companies like to either increase their dividend or keep the dividend consistent. That's part of the appeal of their actual stock itself, is the ability to provide that consistent payment back to shareholders as a reward for believing in the business. And you've kind of got that approach of balancing the single stock again when you invest in the dividend investing space. Growth potential is obviously not capped now. So you can earn whatever that stock is going to go up. So if Nvidia goes up 200%, you get the 200% in Nvidia. You still get all of the downside of Nvidia, same as with the cover call strategy. Again, similar to cover call, you've got the higher equity risk. Now, there is some argument that covered call versions of a single stock is better than the risk level on a single investing stock, because if you get the income, you're offsetting some of that risk. I kind of argue it's not necessarily as big as people say, because ultimately both strategies are relying on the fact the underlying still being around, because a cover call is useless if the underlying goes bust, and it's same for dividend investing. You're still taking on all of that single risk stock. So again, it's very passive. You just sit there and you just get the income. Now, it's simple in that sense, but we've got to remember the fact that you still have to do the research on the individual stock. You've still got to be careful of, will it cut its dividends, what its dividend history is. Does it have a track history of increasing its dividends? Does it generate the revenues to cover that, from a free cash flow perspective? So you do need to do a bit of work. But again, there are ETFs that are dividend associated ETFs, which are very, very passive in nature, like JGGI, SCHD in the US, etc. Okay. A stalwart of most portfolios and always recommended by financial advisors is kind of the concept of bonds. Obviously, bonds in terms of income are relatively low, but they are very predictable and typically a lot safer. And so, is there any growth potential? No, it's just about keeping your cash stable, and it kind of goes up with kind of interest rates. So typically it's a good way of keeping balance. The risk level is very low. There's typically very little risk if it's a bond that's well secured, like maybe a UK Treasury bond or a UK bond. government bonds are typically pretty safe. PIMCO are probably one of the biggest providers of bonds out there from that perspective. Bonds have been used a lot in portfolios over the years. I was a proponent of bonds. I prefer now earning through things like gold and silver. I think they're also good, but they're often typically not recommended. I think the shares funds around gold are brilliant because you kind of get to own gold ETF as the underlie, but you also get to earn a bit of income from it, which I think is a lovely mix of the two worlds. From a simplicity, it's kind of moderate. There's still a bit of management, but it's not too bad. Annuities, these kind of are contracts and the income is kind of guaranteed. There's a bad of that, but its growth could happen. But if it does happen, it's typically quite low. There is a risk associated to the insurer of the annuity, but again, the risk level is again quite low. And then this varies depending on the type of annuities you take out, can vary with the complexity and the simplicity. So there's a mixed bag there when it comes to annuities. So you've got cover calls, you've got dividend investing, you've got bond ladders and commodities, and then you've kind of got the annuity side. All have different risk levels, all have different simplicity, all have different growth sides, and all have different incomes. Obviously, I have kind of left out the traditional just buy the S&P or buy the NASDAQ, just pure growth, because I wanted to look at the end of the day, retirement, about where are the different strategies when it comes to an income portfolio from a strategy perspective. Okay, so what's the final thing? Can I live off purely covered calls? The way I always look at this is it's not a standalone solution. It's all right as a retirement thing. You do need to look at the trade-offs, and you really ultimately need to try and get a more of a balanced portfolio. Now, every investor has their own view on this. They all have their own stages in life. You've got older investors who are maybe more income targeting and maybe prefer to take the extra risk for the extra income because of where they are at life. You've got younger investors that are maybe more growth focused, but want the dividends to fuel that growth, because you need to get the income somewhere to actually put into the growth stocks. So again, I always think a balanced portfolio is better for retirement than putting all of your eggs in one basket. For me, that doesn't change. Could you arguably live off cover calls? I know a YouTuber out there who is solely relying on cover calls to live in retirement. Would I be that person? No, I would look at more of a balanced portfolio and certainly have income as a percentage of that, but it wouldn't be my sole percentage. So there you go, guys. Again, always consult a financial advisor, talk to a tax advisor. Everybody's financial goals and risk tolerances are different. And so I'd highly encourage you to get the advice out there. Again, this was just for education, entertainment purposes only. Hope you found this useful, and I'll catch you on the next one. Thanks a lot, guys.